Good morning and welcome to the second annual Venture Debt Summit. My name is Tal Schwartz. I'm head of strategy for the Canadian Lenders Association. So if you were at this event last year, you'll notice there are a couple of big changes. Last year, we were discussing how to stay competitive so late in the market cycle. This year, the conversation's obviously going to focus a lot on government stimulus, economic recovery. Last year, we did a lot of schmoozing at the open bar. This year, we're sipping coffees in our pajamas at home. That being said, we're encouraging you to schmooze. So please, use the chat box to the right of your screen. You can put in your LinkedIn handle if you want to go and connect with folks after the discussion. There's also a Q&A box either at the top or the bottom of your screen. So feel free to write questions to the panel anytime. Two quick announcements before we begin. One, if you are a lender or a service provider to the lending industry, we would love for you to become a member of the Canadian Lenders Association and really take a leadership role within our community. We are the largest lending community in the country. And two, I'd like to thank Echelon Capital Markets for supporting this presentation, supporting the CLA. Echelon is the preferred capital advisor to CLA members. So now let's get to it. I'd like to introduce you to Pavan, partner at McCarthy Tétrault, and your moderator for today, Pavan.
Thanks, Tal. So as Tal mentioned, my name is Pavan Jawanda, partner at McCarthy Tétrault, based here in Vancouver on a beautiful, kind of great overcast day. So thanks everyone for joining us virtually. Like Tal mentioned, it would have been great to do this in person and actually get to see faces live as opposed to little thumbnails that I'm seeing on the screen right now. But appreciate everyone joining here during their morning and making time for this. Which should be a really informative panel here. We have kind of a very eclectic and diverse set of representatives from their firms today. They will bring very different perspectives, whether it's from specialty lending, whether it's from a bank perspective, whether it's from an advisory perspective. So very much look forward to this conversation today. And like Cal mentioned, obviously, if you guys do have questions as we move along, we'll try to answer kind of whatever fits in to our time and kind of the dialogue that we're having. So feel free to pepper us with questions as we go along. And if we don't get to it during the panel session, we'll definitely try to save time at the end to answer them at the end. So with that being said, I'll kind of let folks, as I get into this dialogue, I won't try to introduce everyone, and maybe everybody could just kind of say a quick blurb about themselves as we get into this dialogue here. But I think the first thing first and foremost that we should just talk about is there are a lot of kind of misconceptions about what venture debt actually is. And like I said, we have some diverse perspectives that work in different types of spaces here, whether it's kind of bank fund advisory, specialty lending. So I want to open it up for the group, and maybe Garron, I could start with you from Venbridge. So lots of different opinions about what venture debt actually is. Some will kind of say this is senior term debt, senior secured term debt. Others will say it's mezz, subordinated debt. Others, like maybe Tony and Brenda, might be talking about operating lines and MRR lines. So it could capture a pretty broad universe of things, and maybe even like shred financing and things like that. So where do you come, Garron, on that spectrum?
I think the answer is yes. At the end of the day, it's a little bit of all of those, in my opinion. So just a quick introduction: Garron Helman from Venbridge. We do venture debt financing from $100,000 to a couple $1 million, primarily based on government tax credits such as SHRED. We also do lending against MRR for SaaS companies, and we will loan against government grants. So, to answer the question about what venture debt is, I guess from the highest level, what I think it is simply for companies that are taking on more risk than is typically thought of in a banking scenario. That's where you get the venture component. So it's typically slightly greater risk, but not like equity. Yet we don't have the upside of equity, and our main goal is to protect the downside of our facilities. And we're there to support other venture companies. So it's not necessarily, is it mezz, subordinate, what type of facility, it's more in what type of companies you're financing and what type of risks that you're taking.
Great, thanks. That was fantastic, Aaron. Mike, from TIMIA, any perspectives from your end?
Yeah, I think the term we use is technology lending, which I would say is probably defined as a broader subset of venture debt. And I think, as Garron said, we like to think of it as we're lending to the other 95% of companies. So 5% of companies are have high potential, possibly could go public on a very large exchange and make billions of dollars. But the other 95% of the companies might not have that kind of massive potential. However, they do have the chance to make tens of millions of dollars and maybe $100 million. Those companies need financing as well, and there are structures that are both profitable for investors and for the entrepreneurs and for the common shareholders of the company that are in question. And those structures, at least as Garron and I have sort of leaned into, have sort of found debt as a potential solution that works for both sides of that equation.
Great, thanks. And then switching your perspectives maybe just a little bit here. So Tony, you're at RBC, so you're a big bank that brings a lot of resources and a lot of coverage with it and a lot of kind of industry expertise. But the one that also might be kind of intimidating and daunting to an entrepreneur or founder dealing with a big organization. So how does RBC approach kind of venture debt, and what is venture debt in your mind?
Yeah, so real quick, so my name is Tony Barkett. I recently actually joined RBC just 3 months ago. I'm as Managing Director of Head of Relationship Management for the New Tech and Innovation Banking Group. Before that, I spent 21 years at Silicon Valley Bank, in the last 8 of those covering the Canadian market. I would say Garron's definition is probably more the Canadian definition of venture debt. We sort of look at venture debt as one actual specific term debt product. Not early stage lending in general. And it's probably the same thought we're going to take it at RBC, which is, term debt financing to complement an equity round. So if you have institutional backers and you're looking to extend runway another 1 to 2 quarters, non-covenanted term loan on top of that is venture debt. It's a percentage of the venture debt equity that you bring, the venture equity that you bring in. And the primary source of repayment is the next equity round. That, by definition, is what the U.S. considers venture debt. It isn't any other form of SHRED, lines of credit. That in itself is defined. And that's how we look at it. And I know in Canada, there's a lot of different variations of it. I think in the U.S., it's pretty common as that's what that is. There's just a lot of other different vehicles and different groups, even on this call, that provide early stage lending. But I wouldn't consider that actual venture debt. I would consider it. So from RBC's perspective, is what we're going to be rolling out in the Tech and Innovation Banking Group is pure venture debt. Complements to an equity round. And it's a smaller percentage. It's, typically 25 to 30%, right? It's not supposed to compete with equity. It's not subordinated debt. This is first lien with a thought to then refinance it on the next equity round. But again, it's venture risk. It's next equity financing risk.
Great, thanks, Tony. And Brenda, again, you're moving across the spectrum here. BDC would obviously bring a very different perspective because it's a crown corp backed by the federal government here, and on top of that, you guys are a very active equity investor as well. So where does BDC come out on this?
Well, you kind of hit the nail on the head that we covered a lot of the span of what a tech company can go through, and there's a lot of different groups at BDCs on how we can support from an early stage. I really like Mike's definition. It really captures maybe what BDC does as well. It's tech lending. Like, it's more how can we support the company? And I would agree again with Mike on saying 95% of the tech companies in Canada that we help at BDC aren't destined for venture capital or don't want or desire venture capital financing as well. So last year, our debt group at BDC did over 200 million in loans to about 700 companies. So you just know on average, when you think of how much venture capital gets put out and the number of companies, Mike's numbers are very right. How many are destined to get venture capital and would fit then? Therefore, I agree with Tony's definition of what venture debt is. It's a venture-backed company, but doesn't mean that all these other groups, we have a very important role to play to support these tech companies in growing, if it's their shred, if it's MRR factoring. And the nice thing is that it's not, I can only deal with Venbridge and I can't deal with BDC or Royal Bank. It's like, no, I can deal with all these parties, and we all figure out where we stack for our security. And okay, yeah, Royal Bank, we get that you have a first and you have an important role to play, so we want you there. And then, oh, BDC can do their part, and I don't do shred lending, so like go to Venbridge, go to TIMIA. So it's kind of nice, but entrepreneurs, I think, often get overwhelmed with where to go and when to go. And that's maybe hopefully what we can address here on this call is when to go. Because I love at BDC, we probably have a place for everyone to go because of all the different groups we offer, but sometimes we don't. And so it's important that we know everyone else here at this table so we can refer companies to these other groups to also get support.
Right. And Karanjit, switching gears a bit to kind of your end, you're working on the advisory side. So you're working in investment banking and actually advising kind of clients and investors on these types of products. What is your definition? But I think the other question I want to ask is, debt, for a lot of founders and entrepreneurs, has negative connotations. They're kind of live their lives very cash flow tight, and to kind of layer debt onto the balance sheet and into the capital structure could seem pretty daunting, and having to service that debt, even if it might be like, say, interest only kind of initially, or at least for a few years, but having debt service obligations becomes a new reality for them that maybe they hadn't had before, especially when top of mind for them is just making payroll or paying rent or funding R&D. And all their friends are talking about equity investments, all their friends are doing Series A rounds, are doing SAFE financings, are doing something else. So how do you obviously you want to get your perspective on kind of what you think venture debt is, and then how have you seen entrepreneurs kind of overcome those challenges and some of those connotations that they have about bringing debt onto the balance sheet?
That's a great question. I'll deal with the second question first before I define venture debt for a second. Oftentimes, and I said this in another panel recently, where I have a lot of clients when I first meet them, and ignoring technology companies aside, just broadly, because we do a debt advisory across the spectrum of different types of companies, they proudly say, we are debt free. We're a debt free company. And many times my response to that is, why? Why is that a proud statement? If you're not accessing debt capital whenever you can access it, I think it's almost an irresponsible use of your capital structure. Now, the question is, when can you access it, which is the point of the first question. Venture debt, I wholeheartedly actually agree with Mike's definition, because the Canadian, and maybe it's a Canadian versus US landscape question, similar to what Tony was talking about, that we deal a lot with Canadian companies. The Canadian landscape, in my opinion, for lending in the sector is broadly technology lending, especially now considering the fact that you have big banks competing against the likes of BDC, Silicon Valley Bank, and in some cases against other technology credit funds like TIMIA or Espresso or the like. And you get into situations where they're offering the same thing slightly to different types of companies and different costs of capital. Now, would you call RBC and their use and their technology funding group a venture debt group? Maybe Tony does, but I almost feel that sometimes venture debt has a strange connotation to it in the Canadian landscape, and I think that's what he was getting at. That we look at it from a technology lending perspective. I actually avoid using the word venture debt to not confuse. We actually raised capital for a technology lender, and when we wrote up the SIM, we did not use the word venture debt at all. Even though that's the space that they play in, because we were afraid that when we were going out to market with various funders, that they would assume, okay, well, this is a venture capital firm. And that's the feedback we got. We said, no, they are a technology lender. And you can construe that in your own way, but we don't want to misconstrue it in a way that's unintended. So our view is technology lending. It could be senior, it could be subordinated. It really depends on the situation. Many times you're talking about situations where there's EBITDA or cash flow burn and that's what's being funded. So that's an interesting characteristic. But we raised an MRR facility for a very mature company that was reinvesting in their platform and reinvesting for growth recently. That was a $10 million EBITDA company. I wouldn't call that necessarily venture debt, but that's part of technology lending as a whole. So hopefully that answers the question there.
That's great. And so, Mike, coming back to TIMIA, everybody loves your definition of kind of what venture debt and the breadth of it. But how are you coaching entrepreneurs on kind of when debt is acceptable to bring onto the balance sheet? Just like I said, a lot of founders, entrepreneurs, kind of management teams of emerging companies, for them, debt, again, it's pretty novel, and they're kind of associating it with the mortgage that they have on their place, and they've never really had it at a corporate level. So, how are you overcoming some of those challenges?
Yeah, we only do recurring revenue software companies. So there's some very specific criterion inside that vertical that make a lot of sense. But generally speaking, across all verticals, I would say funding sales and marketing growth with debt is a good idea, and funding product development with debt is a very bad idea. I think that's a very simple delineation. The risks inherent in product development don't lend themselves well to the kind of defined timeframes that you need to pay your debt back in and the extra cash flow that you need to generate in order to pay it back. But if you understand your sales and marketing process and you have a very clear idea of how much extra revenue you're going to be able to generate if you invest in new salespeople and new sales tools, expanding into new markets, and you know that you can generate extra value for a $1 million investment in sales and marketing, then that is a great use of debt capital. So I think that's the most simple sort of breakdown I would think of. Another use that is possible is really maybe buying out shareholders. If you have lots of angel-backed companies, have a long history and a lot of tired angel shareholders who they just want out. They don't want to buy into the future. So if you're of sufficient size that you're able to carry the debt load and not burden the company too much, it is a good way to get rid of those shareholders and stop getting those angry phone calls every quarter.
Right. Yeah, so you mentioned something interesting. So obviously, your space is, recurring revenue companies. So you're most likely SaaS companies with predictable kind of recurring revenue, hopefully little churn. So, maybe that's a good segue to the next question about, what your ideal deal or borrower kind of profile really is. And so what types of companies you're looking for, what types of verticals you're really interested in, what are some of those threshold financial metrics, how much revenue is enough, do these companies need to be profitable, do they need to have cash flow or EBITDA? I think an important question for maybe a lot of folks on the line is, do they need to have venture backing or some kind of real institutional sponsor behind them, or a concurrent equity financing, Tony, like you were talking about, that you guys can tack on to. So, what are you guys looking for? And I know kind of your perspectives on this are going to be very different based on the spaces that you guys operate in. But maybe Tony, we could start with you from just a bank perspective. What is the RBC's kind of ideal profile, or just your target profile and parameters?
Yeah, I think it matters if they're making money or if they're losing money. If they're losing money, then they obviously need, in our mind, they would have to have some sort of institutional backing, right? Just to sort of support their cash burn and development. So it's the institutional investors that are backing it. It's the management team. It's the growth trajectory. It's the TAM. How disruptive the IP they're developing. Again, this is technology and life sciences companies that we're looking to work with and lend to, not necessarily services companies on sort of the tertiary of tech. But so I think if they hit all of those qualifications, and then to Mike's point of a SaaS company, then there's specific metrics around that, on margins, on LTV to CAC, and making sure that model actually, even though maybe it looks like it's going bad, is going to turn itself around, and that's where that debt investment is for. Now on the flip side, if they're making money, then it's a different risk, right? That's pure business risk that we're looking at, and what are the metrics we can tie to the company, and how much money can we put on their books that they can potentially repay, whether in a cash flow term loan or an operating line, right? So it's either sort of venture risk again, to some extent, depending on where they are from a size perspective, or it's business risk if they're making money.
Okay. Garron, where do you fall on that? So what's your ideal profile for a potential borrower?
Yeah, it's a great question. So we service quite a different niche, I'm thinking, from the other lenders, primarily because we're bridge financing rather than long-term debt. And so the folks who approach us are looking to solve a particular opportunity or problem. And so they fall into one of two categories. One is that they've hit a bump in the road. They didn't expect something like COVID to come along. And so something happened to them and they need to get to the other side of this. And as a result, they look for us for some bridge financing based on what we consider an underlying asset being their shred claim. So that's the one type of borrower. And for them, we just really look at that underlying asset as the main underwriting criteria. And we want to see that they have enough wind in their sails to make it to the other side and how we can help them do that. And then the other side is, I guess, what other folks are more commonly lending against, which is this is a strong company. They want to offset their dilution in their equity, or, we finance a number of companies that took our debt, deployed it to what the rest of the panelists are talking about here, sales, marketing, growing the business, getting more clients, getting more product market fit. And as a result, they're doubling their revenue and drastically reducing their dilution when they are going to market for that next equity round. So there's really a few different reasons, and probably the most strategic ones are the folks who really understand very well how debt can reduce their dilution as they're growing their business, and to balance off the debt load and that servicing of the debt with the long-term success of the business and how much they're going to be giving up by selling more equity. And they're definitely complementary. And so the criteria for us for those types of companies are not dissimilar to everyone else here, maybe with the exception of RBC, is that we don't need it to be sponsor backed. I mean, if it's angel backed, or as long as there is some equity in there, we don't want to be their only source of capital. But as long as there is equity in there and we have someone who we believe is supportive of the company, aside from Venbridge, we'll be able to finance them most likely.
Right, and Brenda, from a BDC perspective, again, very different angle. How do you approach, borrowers and underwriting limits and things like that, from the Crown Corporation perspective?
Yeah, well, there are some similarities, but the biggest difference, obviously, will be that we're a development bank, so we will tend to get in earlier and take higher risk because that's kind of in our DNA to do that. So, but I will agree with Mike is that when BDC is helping a tech company, we're not taking the tech risk. Maybe with the exception of a venture capital group that is different and they have different return mechanisms, so they will consider the tech risk. But if it's our debt instrument we're looking at, they come to us already with at least version 1 built and a paying client, or at least a really firm contract in hand. So it's kind of remarkable that as a debt financer, as a bank, we'll consider them that earliest stage, that you have just started your revenue traction, you're definitely in burn mode. But to Garron's point, you also have passed the family and friends round, you have some angels, you have someone else that's bought into your story, that believes into your story, that will be there to support. Because we know BDC, we can't do it all. And although, yeah, there's a lot of money at BDC, there's got to be other people participating and sharing in the risk with us to help these companies grow and scale. It's definitely what we like to say is that we're putting, and it's not bridge like Garron, it is a term loan. So it's that permanent injection of working capital to help them hire maybe their first salesperson because the CEO's been doing it all along, or maybe it's to expand geographically because they do have like getting close to $1 million in revenue. Now it's time to finally explore the US. So we're helping them do some of those hires. And it's usually coming at, as everyone's describing here, is they have this inflection point. They know if I get that next contract in the US, and that means in the next 6 months, my valuation will have jumped to here. And that's when I want to do the next round. So they love the idea of the non-dilution. That is great to extend their runway and give them that added value to where they will be prepared to keep diluting. But debt has, like Mike said, you have to at some point pay it back. BDC, we can be as patient as a 5-year balloon. Like we can go to look very much like quasi-equity, but that means you have to have either a plan to profitability or a plan to an exit. Like, where is this company really going to go that we can get the money back? It's also different kind of security, right? So a lot of the tech companies we talk to, sometimes we're talking about personal guarantees. And that is not a spot they've ever gone before. They've, given off shares. It doesn't sometimes mean that much to them because it's just a piece of paper. So when you start talking about, now you're signing something that has, for a bank, that more commitment, and it's not in every circumstance. And there's lots of cases where we can say, oh, you need to give it to us now because we're getting in so early, but it will be released or relinquished later on. Like, there are different ways of structuring security, but they don't always understand what a general security agreement is, what the first on the intellectual property is, because as I said, like, Royal Bank's going to want that too. So, and all the different pecking orders, and then we become working with all these different groups on who gets priority on what piece of security. It is, as I said, we work really well together, but it means there's extra layers of security and working with lawyers to get it all hammered out to how we support these tech companies. But I like Karanjit's point, like, you have to look at all your different sources of financing to get the best cost of capital. Because some companies will be very proud that they bootstrapped it, which, I mean, at BDC, it's in my heart, I love that. But did you hold your company back from growing by not taking on some debt, by not putting some more accelerant on it? But some people aren't willing or wanting to give up ownership. And I think that's where these groups are saying, you don't necessarily have to either. There's other options to not go the equity route as well in huge dilution. So a lot of different options, but entrepreneurs at the end of the day have to figure out what works for them, and what is the real ambition of the company too. Like, what's its business model? What's its real market potential? Where can it really go?
Great, thanks. I heard, I know we're kind of doing this virtually, but I think I still heard the virtual gasp when you mentioned personal guarantees there for the crowd.
Yeah, I like to do that. I was like, what to see people react. We were doing more without personal guarantees, but when you consider the early stage that BDC is willing to get in, sometimes it's a hard conversation to have, but it's kind of like the conversation around valuation. What is your company worth today? So those discussion points are great to have with the entrepreneurs and shows their commitment to the business. How do they feel about it? And maybe that's why, like I said, last year we did $200 million of debt. Those have personal guarantees on them. And that's perhaps why our portfolio is very healthy. There's very low write-offs in our group. So it is entrepreneurs that have that commitment. They have the support of the other equity investors. So it's been working at BDC.
That's great. I guess for this next question, I'm effectively going to split this kind of group up. And I'm going to put the small guys against the big guys here, and then Karanjit, you're going to play intermediary, and I'm just going to get out of the way while you guys throw fists at each other. So the landscape in tech lending has definitely changed, I would say, over the last few years. So while kind of tech lending and venture debt, used to be a true VC or specialty product, we've seen now, the larger Canadian banks, really make more of a splash in this space. Tony, you for example, at RBC, BDC's obviously been very active, probably one of the biggest equity and debt investors in the Canadian tech sector. But RBC, we have Silicon Valley Bank that obviously recently opened up in Canada. We have CIBC, the other innovation banks that are popping up and becoming the new crown jewels of the banks. And so banks obviously bring very different things to the table. Big institutional debt investors bring different things to the table. So an RBC can provide a bank account, can provide a credit card, and it may not take a warrant or an equity kicker on a deal, but oftentimes kind of planting the seeds for a relationship, maybe an investment banking mandate, maybe an IPO or some M&A work. But for entrepreneurs, it may be kind of intimidating to go to a big institutional lender here. So how do kind of the banks and the BDCs of the world kind of fit into this landscape, kind of vis-a-vis the TIMIAs and the Venbridges? And then Mike and Garron, I'm going to just ask you to pitch against them as well. And Karanjit, you can provide your kind of intermediary advisory work here. So why don't I start? Maybe Tony, you could Mike, I'll start with you. You seem like you want to have something to say here.
I love this conversation. It's interesting. The one thing nobody's talked about is rates. And a lot of people, certainly the entrepreneurs want to know what the rates are. And I, in my conversations with entrepreneurs, will always be the first one to say, look, if you want like low rate, and you have a sponsor, which means you have a venture capital backer, go talk to Tony at the RBC, right? Because he's going to be able to give you something that the private funds can't do. And that's a low rate facility, but it's going to come with a bunch of things on it that you may or may not like. And then you're going to move on. And if you want to move into a different level, if you don't have a big brand name venture sponsor in your group, then you might move on to Brenda at the BDC, because she's got this, first of all, she's got a whole range of products to give you. But her, you know, in that mid group that we sort of work collaboratively with and sometimes compete against, there's this mid layer of pricing that is better than ours, but not as good as what the RBC might offer. And then there's the rest of us up top who are more aggressive, taking more risk, and maybe we're able to do American deals, for example, or deals that have different kinds of hair on them, but we're up here at the high end. And what we're going to have, our list of covenants in our deal are going to be a lot shorter and a lot easier to deal with than the RBC down here. Tony, you might disagree, and probably easier than what Brenda's got in hers as well. So it's a spectrum really of what is the chemical makeup of your company in terms of the risk profile and your backers and your geography and maybe your kind of other hairy issues that are associated with your company. What are you able to pay? What are you willing to pay? Where are you in your development cycle? And where do you fit with us? And so it's entirely possible. And we have done subordinated deals to, you know, large banks like RBC, and we've done subordinated deals to the BDC. So there's actually possibility of us either competing or collaborating depending on the exact situation.
Just to add quickly onto Mike's point, the other consideration, if you're paying an extra couple of points to TIMIA and they're giving you 50% more capital, does that economics make sense for you? Because a lot of the secondary lenders, they know they're more expensive, and part of the value that they add is being able to deploy more capital and hopefully help accelerate that growth more. So those are the trade-off decisions which someone like Karanjit can really help with to understand, you know, what's too much debt, what's too high a rate, what's a secondary lender going to offer in comparison to a bank.
Yeah, I mean, maybe if we kind of add on to that, it's really a total cost of capital stack question more than anything else. There is TIMIA and Venbridge and others play a role, and their role largely is to be an alternative to equity for in most circumstances to be a more aggressive source of capital. And there's going to be earlier stage companies that may not be eligible for a bank deal, or maybe they may not have the venture capital sponsorship for a bank deal or a BDC type of deal, or in the case of situations where people don't want to give up a personal guarantee, like what Brenda was suggesting earlier. But what we always encourage our clients is you take a look at what your total cost of capital is for your entire stack. That is how much senior debt revolver you have, how much you can get from term loans, and then what your equity is. And you have to assign a cost of capital to your equity. I can't even count the number of situations where clients are treating equity almost as if it's free. And you know, as a standard rule of thumb, you know, if you're not charging at least 25% for that cost of equity, you're doing yourself a disservice, especially if you're in an early stage business. So, you know, it's you know, corporate finance 101, where you kind of do a whole whack calculation on your total cost of capital, and then you're coming out to what's the optimal solution for that client, and in taking into account what their strategic objectives are and who can further them the most. So I totally like Mike's approach to this. There are situations where different stacks can be working collaboratively, and there's going to be some situations where there's going to be competitive, but it's not as competitive as one might makes it seem like, because many of the companies that would be very applicable for TIMIA would not be applicable for RBC, and vice versa.
Thanks, Karanjit, for jumping in. This actually isn't as bloody as I thought it would be. So, you know, maybe disappointment to the folks that are on the line right now. But I'll give the big guys now.
It's called a Canadian argument. That's what it is.
part of the collaborative stack or whether it's actually competitive. So Brenda, do you want to give BDC's perspective on kind of where it fits into the landscape and where it fits into maybe a capital stack?
I feel very Canadian because at BDC, the nice thing is like we don't have operating lines of credit. So I need a Royal Bank. That they need to be supporting our clients. They always need that lender. And I like what Mike and Venbridge and Garron offer. Like our entrepreneurs need that, and we don't offer that directly at BDC. So in the stack, but like just going back to that whole personal guarantee things, yeah, if a client says that's not an option, I don't want to give it, I have put so much of my own money in there, I've got significant equity investors, then we're like, sure, I'll consider that. And guess where my pricing is going to go? It's going to be right in line with something that TIMIA is offering, because now I'm being more in that. I don't have that extra security. So we can price low in some situations, depending on the risk. It's risk profile, right? And if they want that flexibility of us looking like quasi equity in a 5-year balloon, you got to expect to pay for it. So kind of like everyone's been saying here, it is the trade-off. Because unless you have everything, and everything to a bank or to the guys here is profitability. If you hit profitability, then we're all like, okay, you can show me, I'll get my money back. You've been able to execute. It's when you're before that stage and you don't have that track record. And yeah, we like to trade on the future and the prospects, but really it's risk. So the reward has to be there. If you're a bank or you're any of these outside groups, there's always a risk. As much as the entrepreneurs say, there's no risk, this is guaranteed, this contract, I have it, it's all good. Like we know, because unfortunately we've got the experience that not everything goes quite according to forecasts or plans. So yeah, and then with our equity guys, like their equity pricing, right? So the nice thing at BDC is we hope to help companies at an early stage, help them grow and scale. Then they have avenues inside of BDC even to keep progressing and growing and us further supporting them. But as we even know with the venture capital world, it's very much syndication and participation. So it is a very small collaborative ecosystem. And I think that's sometimes overlooked almost with the entrepreneurs too, that we all talk because it's a small ecosystem. So if there's a really great deal out there, I might call Mike and say, hey, I can't do it all. So can you help this company too? So, and even within BDC, some entrepreneurs don't tell us. So I'm talking to your equity group. At the same time, they're talking to the debt group. And it's like, do you think we don't talk? So it's best to be open. And like, I am talking to these parties. I understand entrepreneurs like to keep some things close to their chest, but at the same time, we help one another. If I really like this deal, I'm going to call Garron and say, hey, they don't have any shred here. This is an easy no, like you should be in here helping this company. So if anything, we can help broadcast and get more of the money involved in the situation. So
great. Yeah. And Tony, I give you a chance to speak here as well about how RBC fits into the landscape. So obviously we're kind of hearing a lot about the collaborative capital stack. So maybe you're at the top on kind of a senior secured revolver term loan, and maybe kind of Brenda and Mike come in on the med side, and maybe Garron does some of the shred financing. But how do you see our RBC kind of fitting into this picture? And how does your innovation bank and tech lending RBC can also fit within your broader RBC, because obviously your bank and you have other products that you guys can provide?
Yeah, I mean, I think the goal is always to help all of our clients, right? And I think the goal of this new platform that we're putting together is to provide more instruments to do that, specifically focused on tech and life sciences companies. But in all reality, we're not going to be able to fill every gap. So I think, I agree with everybody here is that, there's ability for us to refer deals and say, even sometimes in client expectations, they come to us, say, hey, we want this form of debt and want to pay this amount. And it's like, well, we can't do that. That risk profile is way too much, where, Mike would jump on that in a heartbeat because it fits his profile much better than it fits ours. So I think the good thing for this webinar is that there's a lot of options. If you're a Canadian company looking for debt, there's a lot of options just on this call right now that, depending on your profile, you probably can find the right instrument to go forward. I think what we're trying to do at RBC is, and this is the first time that there's ever been a sector focused national platform in RBC. So we're no longer regional based. So now we're all purified on our tech and life sciences. So I think that's how you sort of better interact with a very large organization, is if it's now nationally focused. that you're just going to talk to tech and life sciences VPs. You're not, and we're bringing in all the groups around that to do that. So that's where it's not, I'm just sort of calling into a big bank and not sure if I fit. Now you fit. Like that's our goal, is to help companies scale and to actually purify our abilities so that there's additional reps, there's proactive ability to reach out and to anticipate things that you need. I mean, that's really the goal of what we're doing. So I think that's how you sort of help with the larger question of how do I sort of work as a tech company in a large organization that may feel get lost. With us, you won't get lost.
Okay, yeah, sorry, through no blood at all, you know, in that conversation. So it's kind of like,
sorry,
yeah,
I'm even in the
Roy Jones fight that happened this weekend. So,
I'm the American too. I should have said something, but no, I love this Canadian. This is awesome.
Yeah, no, it's great. Okay, well, yeah, maybe I'll ask another pointed question. Maybe this kind of separates the room here a bit. How often? So, you know, we're talking about non-dilutive capital here, and everybody's kind of, you know, here, you know, lending and, you know, trying to convince entrepreneurs to move away from equity because, you know, debt has kind of viability in the capital structure and might make sense. But how often are you taking warrants or equity kickers in your deals? Are they a requirement? Is it kind of mixed practice, or do you just not take them at all? So maybe I'll go around the room. Mike, I'll start with you.
All right, I'll be controversial. We don't take warrants. Our value proposition is keep more of your company. And we feel anybody that does take warrants is violating that value proposition down the line, and I'll set that up for the rest of everybody. We don't take warrants.
There you go. Pointed words. Sounds like the gauntlet has been set. Garron, anything from the Venbridge perspective? Are you taking warrants on some of your deals? Maybe not on the shred financing.
Right.
Yeah,
we don't ever take warrants on the shred financing. On the MR financing, it is very rare. It's only if, you know, we kind of go over our skis a little bit to help the company that we will take a warrant, but it's very, very rare for us.
Got it. Brenda?
Warrants as an instrument, very rarely, I would say, but there are kickers. So on different sort of metrics, we will take kickers to get that additional return. But that's because maybe we're giving a lower interest rate right now. So you're getting the lower cost of capital, and then at the maturity of your loan or your sub-debt loan, that's when you'll pay. But that's usually driven by an exit event or something, definitely enhanced growth and value in the business. So yeah. But warrants are an expensive instrument. We try to keep the legal costs down.
Tony?
Yeah, so we currently, we don't take warrants today. As we sort of roll out the venture debt product, and I guess the venture debt product I defined, we would probably take warrants, right? I mean, if you're lending to a company that raised $6 million that has zero revenue and not a product yet, there's additional risk there that the warrants are sort of in line with, right? It's pure venture risk of the next equity round if the company has a product market fit. Obviously, if it's a later stage company and the revenues are there where you can look at some other ways to de-risk it, then you could talk about the warrants. But if it's pure runway extension, and to some extent, it's actually tech risk. Now that point is not just sales and marketing lending. That's actually where they're still in the product market fit stage, and it's that early you can get venture debt. Then we would probably look at doing a warrant, but that's still trying to figure out sort of the best case. But at the end of the day, those warrants are around 0.25% of the company. It's not egregious when you think about the amount. And if it's the end game is either a large M&A or the end game is IPO, it's very small to the ability of getting $2 to $3 million on top of a $10 million equity raise. It's actually not that egregious.
If I could, maybe I'm interested to know if anybody around the table has ever actually calculated out on a portfolio or a Monte Carlo basis what the actual value of warrants has ever been to any kind of a portfolio. I read an interesting article from a guy that Hercules Technology Capital down in the States, a big venture lender down there. He didn't, he basically came to the conclusion that warrants at the end of the day don't pay off enough to actually make it worth even maybe the legal costs associated with it. And I'm wondering if anybody around the table has any other experience or has done any calculations on that.
Yeah, I would say just a lot. So the SVB world, and I think it's sort of, you could see through their financial statements, the warrant portfolio has completely justified that early stage practice of venture debt lending.
I think it bifurcates around whether you only invest in venture-backed companies or not. And I think if Silicon Valley Bank's role in the world was to simply, invest in brand name VC backed companies, then warrants would possibly have a higher value than investing in companies that are either angel backed or founder backed or family backed that don't have that kind of upside. And I think if you only got the one group, then maybe warrants make sense. But if your basket of companies does not include brand name venture backed companies, then I would argue that I bet warrants aren't even worth the paper they're written on a portfolio wide basis.
Yeah, Mike, I think you bring up a good point. I think that sort of goes to my definition of venture debt is backing institutional investors, right? Series A, Series B, and maybe sometimes seed. If you're looking at that, then it does pay off. If you're right, if you're looking at angel, like we couldn't do a venture debt deal to an angel backed company because there's no established form of additional investment from the angel that you can underwrite to as a source of repayment. So you're right. I think in those cases, if you're looking at alternative equity raises, then you're right, that may not actually roll out. But if you're looking at how I would view venture debt, it's shown that it has paid off.
And Karanjit, I'm going to turn to you. So you and I have kind of worked with and opposite, pretty much everybody, on this panel, and I can't speak to it because I'm the neutral moderator and the neutral lawyer, but what's your perspective? What are you seeing kind of across this room and across the markets with respect to warrants? And, do you sense that kind of founders and entrepreneurs for that, that becomes a bit of a deterrent from, going the debt route because there is an equity component to it?
No, it's a good question. So typically on bank technology lending deals, we're not seeing any warrants, and the likes of say BDC would be included in that as well. Where we do see warrants is more on the alternative lender side of things. But to be quite honest, we're not seeing them that often. And one thing we're not really talking about, which I'll bring up now, is it's partly due to the frothiness of the debt markets in general, right? It's competitive out there. It is competitive, and any lender, whether you're alternative or whether you're a bank or whether you're BDC, if they don't admit that it's in a competitive environment right now, they're lying to you. So it's a competitive environment. It's a very frothy debt environment. If, for example, and not to pick on Tony, because I like Tony, if, for example, RBC says tomorrow, we're tightening up on credit and we're not going to do as much on technology lending, well, then all of a sudden it becomes a little bit more of an open market for some of the alternative lenders. And let's not kid ourselves, warrants will come more part of the equation, right? Because you go from being a price taker to a price maker a little bit in some of those situations. So I think part and parcel it has to do with definitely some of Tony's comments and Mike's comments about the stage of where they're at and whether or not they're getting VC funding. But also, I think there's a market issue here. The market issue is, broadly speaking, debt markets are wide open right now. It's very frothy, whether you're a tech lender or whether you're not. And warrants are, in a lot of cases right now, off market. So I think it's justified in some cases, but right now, the way we're running our processes, and if there's a company that is attractive enough, we would advise going after the cheapest cost of capital, which would be not including warrants. So we're not seeing it much.
Okay, well, it's helpful. So, it's a good point, Karanjit, on the frothiness of the debt market. So I want to kind of stay on the theme of frothiness here, especially since it's the morning here on the West Coast, and I still haven't had my coffee or my cappuccino yet. But another, frothy markets, or frothy markets are the equity capital markets right now. So, especially this year in tech, we've seen investors really flock to tech. So while the equity capital markets are obviously really still quite volatile, tech has had an amazing run this year, on the TSX, on the NASDAQ, on the NYSE. IPOs are back with a vengeance. We're seeing tech-focused private equity firms now really kind of emerge as another source of private capital in addition, to the kind of more conventional VC firms. And all of this is despite everything that's going on around us right now. So, most of these tech companies, or a lot of them, especially if you're in e-commerce, in SaaS, in life sciences, anything to do with health tech, are trading at 52-week highs right now. And we have around us a global pandemic and potentially a global recession. We have the U.S. election year, unlike any other. And we have the fact that all the panelists right here are sitting at home in their living rooms or in the dens, most likely in shorts like I am. So how are these frothy kind of equity capital markets and these unprecedented times affecting venture lending? Karen, I'll start with you.
It's a good question. I think that the equity markets are helping the debt markets also. There's more debt, there's more liquidity out there. It's helping companies grow. It's helping accelerate their growth. It's refocusing the economy on a digital economy. And so I think that for tech lenders, we're in general in very good space here. And so at least for our particular part of the world, it's been a very good time, and it's not surprising that there's more competition because we're the place where our theories about what will happen when there is a downturn in the economy, I don't think any of us have been really tested with all the government stimulus, but for the most part, our theories about why our funds are secure and why it's a good investment have held true.
Great. Mike? Mike, I think you're on mute.
Yeah, rookie mistake, sorry. For us, it's pretty plain and simple. We've been bought out of about 25 to 30% of our portfolio this year by M&A or private equity growth rounds, which is a double-edged sword. Both we're delighted for the companies and the entrepreneurs. We're delighted to have made the extra kickers on the early buyouts of these loans. But at the same time, our portfolio size is smaller than it otherwise would have been at the end of the year. And so we've had to go back and redeploy all that capital into new deals. So it's kind of a double-edged sword, but that is definitely what we've seen in the technology space this year, is a tremendous increase in the amount of activity.
Tony, from the RBC side, how are the equity capital markets, which obviously RBC is very actively involved in as well, affected your practice?
Well, you're seeing it basically on both sides, right? There's, like Mike said, of the M&A market. So you're basically losing companies in the top end, but you're also getting an abundance of a pipeline building up at the bottom end because there's still a lot of capital on the sidelines that are just getting funded. And companies are still getting funded. They're getting funded well. They're getting pretty good valuations. So, you sort of lose here, but then you gain here. So it's a constant, churn. You're just trying to rebuild. And that's just part of the game. That's part of this sector. That's unique, right? It's a constant push. The high flying companies are the ones you lose quickest because they're gone, and you just got to keep backfilling. But the good thing is we're seeing a lot of activity in the bottom end too. A lot of deals getting done.
That's great. Okay, I know we're kind of running close to the end of our time, and at the end of this hour we actually do have just a little bit of time saved for Q&A. So obviously, if you do have questions that you want to ask, feel free to drop them into the Q&A box right now, and we'll get around to it right after we're done. But we did get another question, Brenda, and this is kind of directed towards you, but I think it'd be helpful to hear everybody's perspective. And so how involved do you guys get in your portfolio companies' businesses? So, obviously a VC investor, an equity investor, is going to bring a very different set of asks around board representation, around kind of governance, et cetera, whereas, lenders just usually don't participate in that. So do you rely purely on kind of your periodic reporting under your loan agreements, or do you sometimes get more actively involved with your borrower clients and, take maybe observer seats or really more informal advisory roles? And Brenda, you guys have obviously a big network and portfolio assets, whether it's on the equity and debt side. How often are you working with them to make introductions to other companies within the portfolio?
Okay, so how actively do we get involved? It depends on which group. So obviously if it's our venture capital group doing the equity investment, they have a board seat. That's that level. If we're our growth and transition financing group doing their sub debt and mezz, on occasion, depending on, usually it's the dollar amount that we're doing and maybe the structure we put under there, we could take an observer position. Sometimes we appoint someone to be on the board. Typically from that team, there won't be one of the employees at BDC. We actually go to a roster of entrepreneurs that we know that have been there and done it before to add value to that board. And then when you're on the pure debt side, yeah, we don't get that involved. Typically it's annual reporting. We are in some instances kind of talking about the ones where we have more of a kicker return, looking to up it to more like quarterly reporting. But debt is a term instrument at BDC. We're very covenant light. So there's not a lot of clauses that you can trip that we'll take action on. So we take a pretty passive role when we're pure debt. So it depends on what type of financing and which group you're dealing with at BDC and how actively we'll get involved. Kind of matches the risk profile, I guess. And yeah, on how we, like, it's excellent that there's this BDC network. So once you're in here at BDC, there's a lot of avenues that will help refer. We get calls from the venture capital guys, mostly guys, and the ladies on time saying, hey, is there anything interesting in the tech portfolio that we should be looking at? So they want to see early introductions too. And it's great that we have that as an offering. It doesn't mean that your only options are to deal with BDC. Obviously, it's a competitive world out there. So it's BDCs in quite a few funds indirectly as well, right? So whether you know us directly, you're indirectly encountering BDC as well. But you don't have to go on to the next group once you're in at BDC, but it helps that we highlight some companies to the other groups and say, you should be on the lookout for this before they go so fast and that BDC misses having a shot at looking at them at all. So that's how we kind of work together. But as I said, it's a small ecosystem. I just as easily talk to Mike during a virtual cocktail reception and tell him about a great company as I would my own colleagues at BDC. So and during COVID, there was a lot of that going on. I mean, BDC, we were here to help, but we couldn't do it all. And we weren't expected in some ways on the employees and the staff to be able to do it all. So it was very much about, are your equity investors coming to the table? Who else is here to support the company? And echoing to your previous question, there is a lot of money out there. So we've seen a lot of it flow into the companies. A lot of support that we've done. It was great that we were there to support, but I don't think we've dispersed all the funds either. Some of it are just waiting. There's been a lot of government relief programs, so there isn't right now that necessarily to draw all of that funds right now. Tech companies weathered the storm definitely better than a lot of other industries as well. So it's been pretty positive. Mm-hmm.
Okay, and then Garron or Mike, a lot of this to either of you. Brenda mentioned BDC is often covenant light, and I would imagine that TIMIA and Venbridge are probably even more covenant light, and getting in there at an earlier stage, and kind of really investing in a relationship. So how do you guys get involved in your portfolio companies' businesses? And either of you can answer, both of you can answer, and then I have one parting question for the group before we all drop off.
Yeah, we very rarely get involved in our portfolio businesses, especially on the bridge financing side. We just more have monitoring, and yes, we are incredibly covenant light. So we just want to be there to support the companies. If they have questions for us, we're happy to help them or connect them to others. But otherwise, we very rarely get involved in any meaningful way.
Great. I think we're just looking at the questions. We've essentially kind of covered them all through this dialogue, this fantastic dialogue that we've all had here. So hopefully everybody is kind of going away with any questions answered. But obviously, if you do have any remaining questions, feel free to poke any of us here, whether it be through email or LinkedIn or any other way that you want to. But parting question for the group is just the kind of catch-all. Broad question again. Like I said, we're in unprecedented times right now. We're all still sitting at home waiting for this vaccine that's hopefully arriving soon. But so adding kind of a level of risk that none of us had foreseen this time kind of last year. But where do you see this venture debt and tech lending and emerging company lending space going in the next 5 years, whether it's from like an opportunity perspective or the biggest risks to the space? And I'll just maybe start again with you, Brenda. Why don't you start, and then we'll just go around.
Well, I see it getting more and more active, that's for sure. When I think of BDC on its own and how we've added staff and people and continue to grow this group and all our groups, having new funds always, like we released the IP fund this year has come out now. So I see there's a strong need to support this ecosystem and keep supporting, especially as we see the venture capital move up. And I think there's a place for us all to play in kind of that mid-range as well. So I think there's going to be more need as we want to see these companies grow. And it's been very encouraged and supportive at BDC at the highest level. And we want to see us doing more there.
Great. Mike?
I guess two things. One, one thing we didn't talk about today was I think Canada is actually a more competitive debt market than the United States is for technology companies in this range. It has a history, primarily, I think, through the BDC. It's been more aggressive around debt because we probably haven't had the venture capital community numbers in relation to our American friends, and so we've had to use debt. So I'd say Canada is more competitive. I would expect the United States to follow along and become more competitive in the non-venture lending, non-venture debt space and some of this other technology lending that we've been talking about. The second thing is automation. I think automation is becoming a big part of the lending machine, and that will be ultimately a benefit to both investors and to the entrepreneurs, because I think it will drive down prices and it will improve credit monitoring abilities within organizations. And as such, I think it'll become a more efficient system from beginning to end. And that'll result in better prices for entrepreneurs as well as better returns for investors.
Great. Tony?
Sorry, I agree. I just think this sector is just going to continue to scale. And as business models continue to evolve, you're going to see debt products to match up with it. The way SaaS is doing it, the way hardware as a service for robotics companies are going to do it, warehouse lending for fintechs. It's just going to continue to evolve, and everybody here is going to continue to find ways to help these companies as those models become more and more disruptive. I just think it continues to scale, but the competition is also there. There's just a lot going on, and there's a lot of debt available, and there's a lot of equity available, and it's only going to get better going forward, I think.
Garron?
So if you were to think about the beginning of COVID, and where would we be right now if the federal governments did not step in with the amount of equity that they've injected into the markets and capital that they've injected into the markets, actually? I think we'd be in a very different position right now. And, when I take a look at how they've deployed their money through BDC and through other government organizations, they've really propped up, which is an underlying very delicate economy. And, we talk about the R word, and we're masking it because of an incredible amount of government funding. And we see that on both sides of the border. And it just is, it's not sustainable. And I believe that what we are seeing now is that, at least in the Canadian government, it's slowly winding down, and they're not putting as much support definitely into the tech sector, but into other sectors also. And that's going to give way to the lending market continuing to thrive and be a more important component of making sure that our economy is successful into the future. So my feeling is that if it's tech lending or equity, as the governments are not going to be pouring as much money into our ecosystem, we're going to become a more important component of continuing to build our economies.
Right. And Karanjit, to bring this all together, holistically, what do you think?
Yeah, no, it's an interesting question. So I was going to lean on what Garron just said. Fiscal stimulus obviously has played a significant role into where we are with the debt markets in general. Banks have to continue to evolve and continue to figure out where to place their capital. And that's why groups like Tony's group at RBC are going to become increasingly important because they have to figure out more innovative sectors and more innovative products to invest into. The interesting thing that I want to point out is we haven't seen a real hiccup in this sector yet, because a lot of the venture debt funds evolved post Great Recession. And people were actually expecting in the beginning of COVID that there was going to be a curtailment in valuations of all companies of all sorts. Well, that obviously didn't happen, and e-commerce took off and SaaS took off and the like. So that's propelling valuation. What will be interesting to see is when and if that does break, because Credit funds will continue having to be more agile as the banks encroach into their space. They're going to have to figure out a new way to differentiate themselves, and they have to adhere to credit policies. If they don't adhere to good credit decisioning, well, the unfortunate truth is there's going to be a hiccup. So I'd love to see kind of how this all shakes up over the next 5 years. But I agree with everybody's point. It's the market's only going to grow. This is the new digital age that we're living through, and the McKinsey study has said a lot to it. That in the last 6 or 8 months, we've advanced on e-commerce more than we did on 10 years. That's an indication of where we're going to go.
Perfect. Thanks, Karanjit. So I think our time is up. I know we've kind of gone past a lot of time here, but this was a fantastic conversation, and very kind of happy, and it was my pleasure to have been a part of it. And do want to thank kind of Brenda, Garron, Tony, Mike, and Karanjit, for joining us today and for all the kind of helpful insight. I know I came away, even kind of participating in the space as a lawyer, working on kind of tech lending and working on alternative lending products, with a lot of really helpful information. So, thank you, everybody. And then also thank you to Tal and to the Canadian Lenders Association for organizing this. And we hope everybody on the line, online here found it really helpful. So Tal, why don't I turn it over to you for any closing remarks that you have?
Thanks, Pavan. And again, thank you to our amazing and very thoughtful panelists. Thank you, everyone, for attending. We will be sending out a recording, so don't worry if you stepped away for a little bit or you missed the beginning. And I think maybe next year we'll change the name of this event from Venture Debt to the Technology Lending Summit. So with that, enjoy the rest of your days. Thank you so much, and we will see you all very, very soon.